before we start the panel, I'd like to invite Timal and Sachit to join us, and also Dr. Dimel to come here. And thanks, Udara, for joining online. What I'll do is actually I'm going to facilitate. I'm not going to ask a lot of questions. I want the audience to ask questions because what he gave was a scary picture. And knowing Sri Lanka, we might not even do the right thing. So let's see what the response is. I'll invite Timal and Sajid to sort of make the opening remarks as well as Udara, and then we'll take some questions. Timal, over to you. Timal is the CEO of the FCC and has over 20 years of banking experience. And Sachit is the director of the Acuity Partners, and previously he had 26 years at HSBC. So I'll start with Timal.
Thank you, Nista. Good evening to everyone. Firstly, let me start by congratulating Nishan for that excellent presentation. Really insightful and thought-provoking. You might even say that I was almost convinced on the desirability of DDR, almost, but I still remain quite skeptical, Doctor. Coming from the banking sector, and there are obviously a few things that I would like to also clarify probably after the forum. But I'll tell you why I remain skeptical, because I think DDR per se cannot be looked at in isolation, right? So you need to also consider what the banking sector has been going through. And let me also say this, I really am not trying to take on two highly skilled economists here. So go easy on me, guys, please. But this is my views on the DDR. So I mean, the banking sector, if you look at it, we've been going through, I mean, really challenging times even before Easter bombings, right? So there was a subdued period of economic development from about 2015-16 onwards. Then came the bombings and the aftermath of that, followed by the pandemic, the 2 years of lockdowns, and so on and so forth. And then, of course, the most recent shortages of fuel, the energy sector impacts, and the impact that has had on our customers, who are obviously the small to medium scale enterprises, as well as some large corporates who are dependent imports and so on and so forth. So if you put all that together, I mean, it has been really a perfect storm, and the banks have been in the thick of it, or the eye of it, right? So in that scenario, and again, I believe you were saying, when you say restating the debt, that was not extending debt, but I believe it was refinancing the debt. And you did say that you were excluding the bills from that. So we are really talking bonds. And that again, and I wish also had somebody from the audit firms in this panel, because a lot depends on how the auditors are going to look at even a restating of the debt or refinancing of the debt. If they do come back on us and want us to take impairments and so on, that it's going to have serious impacts on the capital of the banks as well as the liquidity. So these are things that, like I said, cannot be taken in isolation and has to be a collective decision amongst everybody in the industry. Primarily is the central bank, the accountants, the economists, the bankers. And from a holistic point of view, and there are certain things that we may have to take a practical approach as well, in terms of how the accounting treatment is going to pan out in a domestic debt restructure or a restating of the debt. And so, I mean, we'll see what the questions are. There are so many bankers in the audience as well. But this is my what I wanted to say, having listened to Dr. Nishan as well. I mean, the banking sector is extremely, extremely concerned about any kind of domestic restructure and the repercussions that it would have on our capital and liquidity. I do see the numbers. I do see where you're coming from, and do understand why this, in a certain sense, may be good for the industry. But we also have to look at the other impacts that this could have on the sector, especially the banking sector. I mean, I don't need to say it. We are the backbone of the economy, and any kind of impact or challenges to that could have major long-lasting repercussions to us. So with that, I'll stop
Okay.
there
Okay.
and see what the others have to say. Thank you.
Thanks, Timal. Sachit.
Okay. Okay. So I start from a premise of low inflation by the end of next year. It's just a base effect, right? I think you'll see that inflation will probably end somewhere south of 60% end of this year, then somewhere around 40% by April, but then a rapid decline from there. So assuming that we take a long run average and impute it to the next 12 months, it could vary for a few reasons. That is quite possible, like the exchange rate, depreciating further, like 360 to 400, 450. So that is a possibility. And the oil prices going up is also a possibility. But if you take all that into account, generally, I mean, we saw that in 2008 also, inflation went up to 25%, but it came down as fast as it went up. So it was like a peak and down, right? It didn't take time at all because, it just big base effect takes in, and, the economy gets rebased from that point. It doesn't mean to say the prices are coming down, but the speed of change is going to come down. So I believe if inflation actually, as central bank also projects, comes to around 5%, or even I would wager that it would be close to zero rather than higher than 10. I would take that chance. So obviously, it could be, as for the reasons that I mentioned earlier, it could vary. So in a scenario like that, the chances of the overnight, I mean, the central bank's policy rates remaining high creates the opposite effect, of the bonds being more desirable at that point, because then you are getting a massive real return, 4%, 5% inflation, and say 20, 30% return on bonds. It will just create a massive interest, especially I think even from foreign investors with that kind of real return. So, and also, I mean, the projections made here, I think, are predicated on these interest rates actually continuing for the next 5, 6 years, 7 years, and each time there's a rollover coming, that it will be rolled over at those rates. So if inflation stays low, and then by virtue of that, the bond yields have to come low, then the requirement for a duration extension or any gain from that is actually negated. Because if interest rates come down, what you would do in a duration extension is basically reprice the currently high priced high coupon bonds, and you are just basically perpetuating, not perpetuating, just taking down the line for 10 years. So it probably might not even be profitable to do a duration extension in a scenario that you assume that inflation will come down and we will probably be able to keep it at that level. Obviously there is some fiscal um, actions that we have to take, and I think the government seems keen to do that and achieve that. So I believe without having to go for a duration extension or a reprofiling, or having to go for a haircut for that matter, I mean, that will probably be a secondary scenario. I think they would probably consider duration extension before a haircut. But I think the probability of those two outcomes, in my view, is relatively low and probably not even required. It just would create unnecessary. And also the current yields represents the fear of a DDR. So if you tell the market tomorrow that there is no DDR, it will probably drop to 10, 20%. So if the DDR is over, the discussion is over, IMF deal is signed, there is no point at that point to, I mean, then the central bank, one of the reasons high interest rates from the central bank's point of view could be to keep a lid on the exchange rate, or prevent any further depreciation. So make the cost of carry high, cost of holding dollars high. So keep the interest rates at 30%, that's fine. Keep moment you lower the interest rates, maybe there could be a depreciation. So in fear of that, maybe the overnight rates or the policy rates could remain high, but yet not at 30%. So based on that, I'm saying, there's no requirement for a reprofiling. Probably if interest rates come down, it will probably be unprofitable for the government to do that, because they lose the opportunity of getting the benefit of their new fiscal policies.
Excellent. Thank you very much. I don't think we're getting into a debate. Udara, can you also share your opening remarks?
Yeah. Hi, everyone. Very glad to be here and glad to, I think, debate and discuss what I think is an important issue that's been at the back of many people's minds over the last 6 months. Let me first just very briefly tell you the methodology that was used in doing the calculations. So essentially, I took all of the outstanding treasury bills and treasury bonds on the end of July 2022. And so that gives me a certain maturity on when the debt is coming due. And I made an assumption of what the yield curve is going to be like over the next 10 years. So one scenario is where the yield curve is exactly as it was in July 2022, and another scenario is when it was back pre-COVID in 2019. So I have all of the treasury bonds. I know when they mature, and the assumption is that when they come due, they're rolled over at the same coupon and yield to maturity. So that gives me a very micro-founded path of the portfolio of government debt. Treasury bills that are coming due were assumed to be rolled over at 1 year maturity. So in terms of the components of other components of government debt, there's one thing which is the coupons which are due, and the coupons that are due need to be paid by issuing additional debt. So the coupons were assumed to be paid by issuing 1 year bonds, again rolled over whenever they come due. And finally, there's the government deficit or surplus, depending on which period the projection is. And this was financed by issuing, again, 1 year bonds. So this was the main components of domestic debt, plus this external debt, which was assumed to be held constant, and the loans as well. So the projections that were done with the actual portfolio of the government in mind. I want to kind of emphasize the point that Nishan made, and I think the previous speakers, Sachit and Thimal, also mentioned, that the yield curve is essentially the metric we should be watching. And the question is, what does it take for the yield curve to come down? So if the yields were at the 2019 level, it is true that even with the current stock of debt, the debt to GDP will come down below 100%. Now, if the yield curve stays where they are now, they're going to explode to 150%. Regardless whether or not we do external debt restructuring. So now the question is, what will it take for the yield curve to come down? Inflation is a response to the macroeconomic conditions in the economy. The monetary policy rate is also a response to the macroeconomic conditions in the economy. So the main player here that we should be looking at is what is the path of government debt, or the path of the fiscal balance, the fiscal deficit, and what is happening with the current account. Now, there was some data that came out, I think, yesterday, which showed what's happened to the Sri Lanka's current account. And there's been a sharp contraction in imports. And as all of you can imagine, this is really very artificial. It's just because it's not possible to import many items that are required. So the inflation reductions that are being obtained is, in a sense, because the imported goods are not available in the market. And so there's domestic substitution happening. As soon as the current account is opened up a little bit, and we're going to see huge capital outflow coming from the trade balance. Now, so that's point number one. The point number two is that the yield curve certainly, as we pointed out, depends on the path of the government deficit, but it also depends on the credibility of the government deficit. Now, and conversely, the government's ability to finance its deficit depends on the yield curve. So it's a chicken and egg situation. And we're in a position where if there's any doubt that the government can commit to a fiscal surplus within 2 years by 2025, this is not going to bring down the yield curves. If we believe that if the market is not convinced that the government can do this, then we're going back in a position where we're stuck with high yields until there is this credible commitment in place. So what we're really proposing through the domestic reprofiling, and I want to emphasize that it is reprofiling, is that we have a credible way essentially for the government to commit to a path of their total deficit spending, total deficit being the primary deficit on goods and services, and the financial deficit on the repayment on their financial obligations. So by essentially doing the reprofiling of domestic debt, they're committing to a certain financial deficit and funding needs. And this is then going to allow more credibility for the future path of the government's policy. In terms of the implications for the banking sector, again, as Nishan mentioned, if the yields come down, then there's actually a capital gain in place. That's point number one. Point number two, in terms of the capital requirements, there's plenty of ways that there can be, with the participation of course, all the players in the economy, including the central bank, where there can be regulatory forbearance. And this will be about moving the valuation of treasuries away from the trading book to the banking book, for example. There's also an associated problem of the non-performing loans to the private sector. And I think it's important to bring this up because one of the reasons many firms are finding it difficult to repay their loans is because of the high interest rate environment that's in place. So what we need to do is to bring down all the rates in the economy as soon as possible. And one way to do this is through the commitment of the government to bring down the yields. And reprofiling debt is essentially locking in the interest income of the banks and this will have an effect of suppressing the yields on deposits and suppressing the interest rates on loans. And this will be stimulatory to the economy. And so my point is to going back to the kind of macroeconomic projections I'm making, I think we need to be very careful of what is exogenously happening and what will be the macroeconomic data that we're going to look at, which will respond to these changes. And I strongly believe that inflation, the exchange rates, all of this is going to be a consequence of the economic fundamentals and real economic activity in the economy and the path of government policy. I think I've taken up my 5 minutes, so I guess I will end it here. I'm happy to take questions later and discuss this further. Thank you very much.
Yeah, thanks, Udar. Thank you very much. Excellent perspectives. Can I open the forum to the audience? Any questions immediately? Yeah, please. I think we have some mics going around.
Thank you. Nishan, thank you for an excellent presentation. I think this question is for you and Udara. I think when you talked about the debt reprofiling, you were looking at the treasury bond holdings. My question is there a reason why you didn't look at the 2.4 trillion face of treasury bills, which are held by the central bank? Look at an option where those are converted into, let's say, 15 to 20-year zero coupon bonds. What that'll do is on an NPV of debt to GDP basis, you might save about 4 to 500 basis points. But more importantly, that will also mean that 2.4 trillion worth of refinancing next year is taken off the table. And that should have a huge impact on bringing that yield curve down next year. Because I do agree with Timal's concern is if you do a reprofiling of the bonds, obviously not different banks have different bond to bill ratios. What you might find is that some of the banks, the immediate capital requirements may be quite significant, even if the banks are allowed to draw down on the capital conservation buffers.
So I'll let Udara come in very fast. One is that by the time you announce and talk about a restructuring, treasury bills can be all over the place, right? They're very short-term instruments and they don't have coupons, as it were. So if you push them into the future, actually there is currently no coupon structure on them. People have bought them at a discount without a coupon payment, and they're going to get the full value later. So that's a far more consequential restructuring, as it were, for banks and others. So the bonds are an easier restructuring to stomach for the institutions, and we find that it's enough to reprofile the bonds. If the problems are much deeper, then you'd need to look at it. But normally we don't. Yes, go ahead.
No, my point was just reprofiling the bills held by the central bank and not the ones that are held by the public or the banks. So that way you might get similar.
Yeah, but that's exactly the same thing as the central bank just refinancing them when they matured. Because this is just money injected into the system, and whether you reprofile them or had the central bank refinance them, you're in the exact same outcome. So it doesn't really matter, right? I would say, and so let me. So I think it's an easy one because that's. But let me get Udar in as well. Yeah.
So I guess I would add that the treasury bills are important for the sake of liquidity management, especially short-term liquidity management. So that's why they weren't included in the potential reprofiling, in addition to Nishan's concern that by the duration of maturity of these instruments is so short that there's really not a lot of time to credibly announce the policy and then to do the reprofiling. With regards to the capital question, again, this is a discussion to be had among the banking community and the regulators. In countries such as Greece, for example, the value of government debt has been taken off the trading books. So whatever has been happening to the maturity and risk of these bonds hasn't been reflected on the capital of European banks for quite a while now. So this is something that can be dealt with. The concern about the liquidity position, so this shouldn't affect the solvency position of the banking sector. In terms of the liquidity position of the banking sector, again, the T-bills are available, and the central bank will have to take a more active role. So if the central bank is injecting short-term liquidity into the market through further extent with further swaps or repos, then this should mitigate that concern. I share everyone's the view that we have to protect the banking system and make sure that financial stability is addressed. But I believe we can do this with coming up with a balance between regulatory forbearance and solvency and liquidity concerns of the banking sector. So these are things that have, as I said, been implemented in other places, and it's no reason it can't be done here.
Thank you. Nishan, I have a question. You mentioned so much about cookie monster. Who, and are there too many cookie monsters? Government, or you find fault with the central bank? And also this question about why is central bank reluctant to go for something reprofiling? They've ruled it out as of now. Is it, and also, is there a lot of misunderstanding that the haircut will be first as opposed to reprofiling?
So I think the point of this analysis is we didn't know what we were going to find till we did it. Honestly, when we started it, we were pretty sure we needed a restructure. But by the time we did the math and looked at the level of inflation, and lots of the pain has already been taken, we saw that a reprofiling would do and would be beneficial. The central bank, if you read carefully, so I'm speaking with no insider information, okay? I must be clear on that. And I try to avoid having that information because it then compromises my ability to be analytically clear in public. They haven't put domestic restructuring off the table. What it is that they've set up some targets and got the IMF to agree that if they meet those targets and achieve, and I showed you a slide on that, that they don't have to restructure anymore. But the perimeter of restructuring expands when you can't meet the targets. And what we are saying is those targets really can't be achieved at the current level of refinancing domestic debt. And then in the IMF's, with the IMF agreement itself will kick in to say, well, you have to meet the targets. And if the only way to meet the targets is to restructure domestic debt, we come to it later with more pain, then take it upfront earlier with less pain. And I think this is really the choice that we have in front of us. Now, there is a third way to think about it that's outside just economic modeling, and I'm going to say it now, so you do pay attention on that problem. It's a political economy problem of this sort, not the one, not about people's resistance, but that Sri Lanka has a government that can't be disciplined without a crisis. So if the only way to discipline the government is a crisis, then maybe we should just allow another crisis to happen. But I don't know whether that's a long-term solution. So if you can't fix governance, because if you create a domestic reprofiling and all it does is allow the government to become profligate and spend that extra saving in ways that are actually unproductive and unhelpful to the economy, you still don't solve the problem. So there is an assumption that the government is also acting responsibly. But if the government doesn't function responsibly, anyway, you're restructuring domestic debt and a lot more, and you're in those countries that are on this side, where the episode of restructure stretches or debt crisis stretches over many, many restructures, not even one or two. So the prior problem to solve is governance. How do you get a government that is professional and is accountable to doing not crazy stuff, right? But then this analysis still holds, because you are still better off reprofiling the debt. It's better for everybody, but you'll be careful that you don't let that benefit can be shared not just between society and the banks. The government might decide we want a large piece of that to spend on elections, and then you are the benefit of it, of course, reduces, right? So we just need to understand the context we're in when we're thinking through. But using economic crisis as a tool of managing government into better behavior is a rather unfortunate way to country, and it means that crisis is all that we will be living with for a reasonable time to come.
Having seen Nishan's projections over a long period of time, I'd just like to find out from him, what impact would your numbers be and your projections be if Sri Lanka goes into, or it succeeds in getting itself a lower income economic group? Would that have a favorable, unfavorable, or have no impact? How would your numbers change in that scenario?
So the numbers don't really change, because these are the debt and debt growth numbers based on yield curves. The benefit of getting reclassified simply is that you get multilaterals able to give you a little more aid at slightly lower interest rates that they could give otherwise. So you can get a little more grants. That's just too small to be worth discussing in this context. But in a humanitarian crisis, of course, it helps. It helps with bridge financing when you can't get back your credit ratings. So it's a very short-term value, and it is not a lot of value either. It doesn't change your debt restructuring dynamics because of the kind of funding that might, even as grant, are not a significant quantum of the debt problem that Sri Lanka is dealing with. But I know that there's a lot of concern or questions about it. Thank you for asking. We don't think it makes a material difference.
Thank you. There are two.
This question is for Udara. we talked about regulatory forbearance on the balance sheets of the banks when a reprofiling happens or a haircut happens. Now, and you referred to the European banking system as that it worked. Because in Sri Lanka is that the Sri Lankan central bank has also run out of dollars. Now, when the European Central Bank spoke to the Greek Central Bank and supported the Greek banking system, there were 2 layers of banking support and liquidity support for the Greek banking system. In Sri Lanka, we seem to be alone. So now the local regulator the Sri Lankan regulator can give regulatory forbearance, but the rating agencies would still continue to see Sri Lankan banks as, you guys are running a balance sheet. If you mark to market, it's not there. And your central bank can't give dollars. So then the banking system is kind of a sway alone. And I'd like you to comment on that.
Thank you for the question. So I think we should take stock where, at least I understand where the Sri Lankan banking system is now. As far as I understand, it's either not possible or it's extremely difficult to get external credit interbank market for Sri Lankan banks. For the central bank, it's also extremely difficult, if not, it seems to be drying up its ability to get even swap and credit line from external lenders. So the situation the country's in already is one where there isn't this liquidity. So the question is, if there is reprofiling of domestic debt, what would change? And I don't see any significant change that can happen because already there's an exclusion from the international markets. On the other hand, by doing this reprofiling and sort of committing, as Nishan said, given a certain governance regime in place, this then provides a signal to the external market that at least the government or the central bank is a credible borrower. Now, one quick way to bring down the yields is to re-enter the international markets. The borrowing costs, even with I think today in a few hours, the Fed will increase their policy rates, but even with that, the borrowing costs for Sri Lanka will go down if it can access the international markets. And that's the key thing, is not through getting multilateral loans or through credit lines or swap lines. The yield curve ultimately will come down through accessing, and that will only come if international creditors believe that the path of Sri Lankan debt is credible. As was said earlier, the predicted or the expected outcome is that Sri Lanka will go through several rounds of restructuring. To give you a number, going back to Greece, the analysis that's been thrown around is that of Greece's debt in 2008, there's been a 65% reduction in NPV. Okay, 65%. I don't know if I can show you if I can share screen. So let me show you with a 65% haircut. This is final consumption expenditure in Greece. This is 2008 when the crisis hit. This is consumption now. So it's still 30% below the peak back in 2008. Okay, so that's what, 15 odd years later. So I think we should have no illusions that Sri Lanka will magically come out of this crisis in the next 2-3 years. I fully take on board the concerns about how much the central bank can support the banking sector from the central bank expanding its scope of operations. So one thing is regulatory forbearance, another thing is providing additional mechanisms for providing liquidity to the banking sector. And a third way, which could also be considered, is the central bank itself issuing bonds as a way to mop up liquidity in the market. This could provide a kind of a dual role of the central bank also managing or influencing the yield curve rather than indirectly doing it through purchasing treasuries. So there's several central banks that where this has already happened. So there are things out there. We haven't got the solution or the proposal. But just to say that this is something that really needs to be taken very seriously and discussed, and the business community coming together to come up with the final proposal.
Thank you.
Yeah, Nishan, I have two questions. You mentioned EPF and that they don't mark to market so EPF is one of the biggest holders of treasury bonds, and yes, they don't mark to market the bonds. So in terms of extension, that mark to market impact may not be there. But they've got payments to make every year. And yes, they do have contributions, but given we have a aging population, I'm assuming that their payments or their outflows every year are growing. And if we have a 10-year maturity extension, that could have a big impact on their cash flows for the next few years. That was one question related to EPF. The second is EPF is also the biggest player in the bond auctions, and so are the banks, at least until foreigners come back in. And even so, I think those two are the biggest players. If we end up having a maturity extension, again, they will have less cash to invest or to bid at these auctions. So again, the demand at the auctions would be less, which might impact yields, unless, of course, you're saying that auctions are there, at least the current auctions are there mainly to raise debt to repay the existing debt. So if that's the case, then maybe the impact is less. But still, there will be less interest in these auctions, which could limit the ability for yields to come down in the near term anyway.
So quick answer. I mean, valuable question. And you have to understand the inflows and outflows from the EPF. And there was a time when the government thought, and there's a paper internal to the central bank, which actually Verite has contested and written an alternative analysis, and we turned out to be more right than we expected to be. That the EPF money inflows will be so high compared to its outflows that there won't be enough government debt for the EPF, and therefore the EPF should go into the stock market. That was EPF's position published in 2018 or 19. And we wrote a paper analyzing actually how this inflows and outflows or government debt will grow. And they simply made some errors in how they thought about the government's appetite for debt. So there has never been a concern internally of EPF reversing its inflow-outflow outcome, especially because people who started contributing 25, 30 years ago and retiring also had lower nominal wages, right? So, and the people who are contributing now have much higher nominal wages. So even if the proportion shifts, the inflow continues to be significantly more than the outflow, because the outflow is coming after 25 years of inflation, which is not fully caught up in the capital that is built up. So but having said that, it certainly would be very good to take a careful look at the EPF's bond holdings. We have an RTI on that to look at the EPF's bond holdings. It's after having won it in the RTI commission, we've been sitting in appeal court for 4 years because the central bank has gone to appeal court, refusing to give us even past data. Because obviously there is a fear of what we will find on how these were transacted in that situation. But I'm in favor of taking a careful look of that. And as you're saying, the EPF, there's no reason for the EPF not to participate in the market unless the government has, this cancels out, right? The EPF is taking 30 to 40% of government bonds. It'll probably continue to do so, but the government will need less money. So the problem is not that the EPF's participation rate will decline. It's just that the government will not come to market with as much that they're asking, and EPF's requirement may proportionately decline as well. In fact, actually, if it doesn't, EPF, since the maturing bonds are less than the demand, if that is on the other side, you could find that when the government comes, because EPF still has only 30 to 40 and government may be asking 100% less on those maturing bonds. So EPF participation could potentially even increase if that were the case. All to say, we have to look at the details and do the math. I wouldn't be too worried of a problem, but certainly whether there is going to be some shift or not would depend on the profile of the debt.
Thanks. Sorry, just one related point. With migrations also increasing, maybe in the next year or so, we might see people pulling out their EPF money, or?
You can, when I think permanent migration, but you have to prove permanent migration, gets you to take EPF money. That will take several years to establish. And I think the EPF is well in control of how fast it processes those things. Again, to say, I don't want to dismiss the question. It may be worth looking at the EPF separately. And of course, one of the struggles is to see the data on the EPF's holdings. So, but a priori, I don't see the dynamics being something to be automatically sort of worried about, but worth the investigation.
I have a kind of question, a follow-up question to what Nishan and Udara. Reality check is that despite having the Fiscal Management Act and also IMF programs, we have successively failed to achieve the responsibility, the target set annually. Even we had 2 opportunities of primary surplus. In that scenario, did your model factor in kind of indiscipline? You mentioned about indiscipline in government. We have proven over the last, ever since the Fiscal Management Responsibility Management Act came. Did you factor in your model, and also in the event of continued deficits and higher borrowing?
So Udara should answer the question. I think our assumption is government has laid out a medium-term framework, right, of how it is going to function and what kind of deficits it's going to run. So the model works on that framework, and this is why I added the rider. That if all we do is create more space for government indiscipline, we have a problem. But Udara, do come in on that, yeah.
Yeah, so the in the original version of the analysis, we took a view on the path of the deficit, and that was, I think, 5 to 7 years of non-positive surpluses. The reason being is that when the economy has fallen so much, and when there's so much need for the government to step in and to support the economy, it's very difficult to think of how you can simultaneously run a surplus. Personally, I find it very hard to believe that by 2025 there'll be a budget surplus. Saying that, in terms of the analysis, what we can show is that even with this what we believe very optimistic path of fiscal and macro projections, debt to GDP will hit 130% under with only external debt restructuring. So you can imagine what the numbers will be with what a pessimistic, maybe even realistic view of the path of government policies. On the other hand, with debt reprofiling, we're looking at 100% under the optimistic case. If you want to add another 20-30% for space for the government to run deficits, this is still actually in the range of sustainable debt. Sustainable in the sense it's not exploding. And so those are the dynamics we want to avoid. And that's why we need to really take hold of this opportunity that we have to show that there is a path towards, even if we're not reducing the debt, there's a possibility that we can at least maintain the level of current debt in the economy.
Okay, Sachit, I want to move on to you. What's the ability of the financial system to fund the budget deficit whilst bringing down interest rates so that the future debt will be sustainable, local debt will be sustainable?
Well, so I think there is going to be a rebasement of the economy. Say at the end of last year, say we had something like 16-17 trillion in rupee terms. I think this year it could be something like 22-24. That is just basic math, right? I'm just thinking on that basis. I think total debt is about 100% currently, based on the published figures, right? Could be here and there, a bit here and there. But if you think, the government could follow the program that they have sort of committed to, of reaching a primary surplus of, say, 1% by 2025-6, and then run a total fiscal deficit of 5%. So even interest rates at 10%, assuming that we'll get there, you can finance that. All right, it will not bring the debt to GDP down, but it will keep it at the same level, just mathematically speaking. So only thing is, if they were to run, so basically the government's fiscal deficit is only to finance the current debt stock then, right? So for that, a primary surplus is required. The problem is, if there's a depreciation, and if we are to now, I mean, our debt stock, the foreign debt stock, actually gets revalued at a higher level, then can the government actually go to the international markets to borrow? I think it's like Dr. Piri said, Professor Piri said, it's all about, the government's credibility. If you have the credibility and if you show actually that the government is moving in the direction that they have actually committed to, right? And the rating agencies will take notice. So we have to put a program where the rating agencies, otherwise, so in terms of foreign debt restructuring, we might need a moratorium of 2 to 3 years. We are not able to reach the international markets just yet. If there is no moratorium, then that burden of having to service that will fall on the domestic bond market. It will become unsustainable at that point for the bond market to be able to absorb the maturities of the foreign debt market. But if not for that, if you can basically kick the foreign debt, further down the road, and maybe a potential haircut of, 40-50%, then I think the domestic debt market should be able to function at the current debt to GDP level.
Thimal, what's the solution from the banking side? I know Sri Lanka Bank Associations are sort of discussing this regularly. What's the way out from a banking perspective? And also, given our experience and past experience of, do you have the confidence that we will, not about the domestic, but even on the external one, whether we will sort of achieve what we want to?
Sorry, are you particularly asking about external debt raising?
Yeah. First question is about what is the banking sector's way out in terms of domestic debt?
Yeah, couple of things, and I think we are talking about if the government does this and if the government does that. But to be honest, at the current rating that the country has, I don't think there is much potential for us to look at external debt raising, right? I mean, that's true for the government, it's true for the banking sector as well. And we've spoken a lot about the domestic debt restructure or the restating of debt in terms of banks. But I think banks probably hold 20 to 25% of domestic debt. There are insurance companies, there is the EPF, like the lady mentioned, ETF. We got to look at all that as well holistically, and the impact on all those sectors and companies on any restructure. And what I think Udara and Nishan mentioned was that they had factored those in. But like Nishan also mentioned, we need to really look at the facts. I think there are lots of assumptions being floated around, but you've got to look at the real numbers and the real impacts and do your analysis before we really go down this road, because the central bank has been quite vocal and they have been quite firm in their assessment that there won't be a DDR, primarily because of the impact that would have on debt sustainability. And I think the governor initially had a fairly good story to tell in terms of the foreign debtors, even about them being the debt sustainability of their current debt being impacted if there is a domestic restructure. So like I said at the beginning itself, we got to can't look at this in isolation. We got to look at it as an industry, as a country, and with all parties coming together, take a holistic look and do the math really and see the real impact before we really start going down this route in an aggressive way.
Thank you. Any questions? Yeah, okay. We'll wrap it up because we are beyond 7:30, but we'll take few questions.
Hi, Nishan. In your presentation, you had made the assumption that the foreign debt, the haircut would be 50%, and the bilateral or multilaterals would take a 25%. At the moment, ISBs are trading at a 70% discount. Why should we look at 50%? Shouldn't we look at 70%? If we do that, do we need a DDR?
So thank you for that question. Timal, I wanted to engage with you also, but and I'll do that after this. So yeah, you're absolutely right. I think we are perhaps missing an opportunity to get a deep enough restructuring on the ISPs, and we should do that. If we do that, we may be able to compensate for not being able to get as much from the multilaterals and the bilaterals. So in reality, we put it together, and that's why I said at the beginning, we should be asking 60% or more from the ISBs, and the multilaterals and bilaterals and the SLDBs are likely to come in lower. Okay, but we allow that trade-off a little bit when we do that. So we can do the math again, but we think overall, when we look at that cut, right, we may end up with it in the same amount in a different shape. But if we don't do even that, then we have a much bigger problem. But I don't think we're in a position to do more of that than we put down in order to prevent a reprofiling. But here's where I want to be heard a little more. We are not saying do reprofiling because you have no choice. We are saying reprofile because you'll be better off for it. Because imagine getting to debt sustainability faster, building investor confidence faster, seeing faster pickup in economic growth. Isn't that of value to the banking system? Imagine that private credit growth can come back in. Now it is negative. So you have to look at the whole picture, as Timal said, and the whole picture is not just looking at what happens to all the banks when we do domestic debt restructuring. You have to look at the consequences of not doing so. The consequences of not doing so are pretty clear. We are going to trudge along like this, and there is no magic wand that brings down interest rates or inflation, or at least if there were, we have to put it down in the math. So, which again, Timal said, so you've got to take this back to your best analysts, and this is why we put the data and the formulas and all that on the site, because, we don't want 10 people talking about 10 models that nobody can look at. And I must say, when you do it, you should put it as a public resource as well. We must create, a public good out of the analysis we do in this critical situation in the country. And I'm sure you guys will do something that we can learn from, right? There's no such thing as a perfect analysis in academics. You suddenly see that somebody spotted something that you didn't spot, but we need to do that as much as possible and get the best possible analysis on the table. And that analysis is not simply about how do we prevent the downside of a domestic restructure. What is the upside of a domestic restructure? And what can we expect on that upside, and how do we then decide between the two on that basis? So I think I'm very happy to be here, because I feel perhaps the best financial analysts are all connected to people in this room in the country, and we should make a project out of this to say, let's throw it up and let everyone put their analysis on I'll host it for you, right? I'll create a website and say, come here and find the analysis of Acuity Partners, come here and find the analysis of DFCC, and start thinking whether there is any better way out of this crisis, because the government does not have this analytical muscle.
Sorry.
Yeah,
Very quick comment. Udar, just 1 minute. Yeah, I fully agree, Nishan, and that will be most welcome. I think we need to look at this as not just in isolation, but together as a group. But from a banker's point of view, we also need to look at what else we are facing, right? I mean, okay, so the so-called tourism moratoriums are ending at the end of this year. And I think the tourism sector, in my view, will bounce back. I think that's the least of our problems. With a little bit of help from the banks, I think the tourism sector can bounce back. But then we are seeing other sectors, the renewable energy sector. We are seeing construction. We are seeing importers going through huge challenges, right? So all that kind of ends up on our balance sheets as non-performing assets, right? So we have to work with these clients in terms of rescheduling their debt and restructuring debt and so on and so forth. The other big thing that is going to happen with if the recommended tax reforms go through, we are going to see a huge impact on the fixed income segments. So we are going to see that side of the balance sheet, the retail segments, which are usually quite resilient, also going through. I mean, they've been paying 12% interest rates, now paying 25. On top of that, the proposed tax rates are going to have huge impacts on that segment as well. So we got to look at what those are going to do to our balance sheets and P&Ls and our capital and so on and so forth. So that's why I'm saying this cannot be looked at in isolation. We need to look at it much more holistically.
Thank you. Any more? Yeah, I know Niroshan. I'll take one at the back, and then I'll come back to you. Nirosh.
Hi, Nishan. On the couple of the last countries to go through this restructure, I mean Zambia and Ghana. Ghana actually went through a domestic restructure, and one of the things which is of interest in terms of the profile of investors is that in Ghana you actually had like 75% of the domestic debt actually owned by private investors, whereas in Sri Lanka, one of the concerns in terms of like, I mean, we see the logic of what you're presenting, and that's one of the what a lot of the investors also feel that if you don't restructure, you're kind of kicking the can down the road. But in reality, in Sri Lanka, you have 75% of debt owned by state or quasi-state entities. And if you have to like recapitalize those entities as a byproduct by the state, then isn't it kind of counterproductive? I mean, the dynamics are very different to some of the other countries which have gone through domestic.
So I should invite Udara to come in on the international side as well. The banking sector does own quite a lot, and you're right that there's going to be a difference in if it's state banks or private banks and how the government actually pumps in the equity. So, I mean, there is another paper that Udara is writing and we are working on to talk about how you protect the banks and how you meet these capital adequacy ratios and what you do and the vehicles that you can use to do that, right? But there can be, if it goes very badly and you do need capital injection, there is a consequence to banks in losing some equity value, but not losing liquidity. So you can save liquidity by asking for a little equity in return, is our view. And there are structures to do that, right? With state banks, of course, there is a problem because the government is already the equity holder. So what do you do? But you may have to start selling some equity in return. But if you have made the system a lot more positive, overall, actually that equity that you're selling can go up in value, right? And banks may not need to trade off a lot of equity if the equity itself rises. So if you get the economy on a better path, the rising tide lifts all boats. And you might get your bank in a better situation. This is what I'm saying. I mean, we haven't done the analysis in enough detail to tell you for sure, but we mustn't preclude the possibility that banks will be better off. And then state banks are also better off, and the liquidity problem can be resolved, right? So I would say a little more work is needed because we don't have enough insight into the details of the banking structure to say that for sure. But when you look at the case for domestic debt restructuring, there are some downsides, but there are some very serious upsides. and how they're going to trade off against each other is an analytical question with some assumptions, with some scenarios. If Sri Lanka is serious about, being professional and coming out of the crisis, I think we have to do the math. But thank you for that question. Very important.
So just a follow-up comment. Yeah.
Udara, you can respond.
Hi. Yeah, so just to kind of add to what Nishan has said, and to respond to the two previous comments. Usually the domestic restructuring or reprofiling has a logic that we need to make a transfer from the private sector to. Now, if you look at, as you said, most of the government debt is owned by state banks or state-owned enterprises. And also this number that I remember is that 40% of banking assets are actually government securities. So compared to most countries, this is in most countries between 10 and 15%. So Sri Lanka has a huge government capture problem on the balance sheets already. And I want to also tie this to the issue of non-performing loans, which I think are going to increasingly be a problem going forward. So the idea is that by reprofiling the government debt and having regulatory forbearance in the way you treat government debt as not mark to market, but just at book value, you're not going to have an immediate regulatory problem. The solvency problem, on the other hand, will come from the non-performing loans. Now, to respond to this, there's two ways to address this. One is through liquidity provision, especially short-term liquidity provision through central bank. And a second proposal, as Nishan mentioned, is in a report I'm working on, but I've also published an article in the FT about 4 or 5 months ago about thinking about creating an asset management company and taking some of these non-performing loans off the balance sheets of banks. So to go back to the point that, yes, we need all of the institutions and entities and people in the market to get together and create a holistic solution. Debt reprofiling will help only to work through the dynamics of government debt. It won't solve the financial stability problem. For these, which is going to be codependent on, it will really require a comprehensive set of proposals. But the fact that government banks and government entities own government debt doesn't mean that it won't affect the path of or the benefit of government debt reprofiling, because banks have depositors and the depositors rates will come down, and hopefully the lending rates to firms will go down as well because of this. So it's not a zero-sum game here. It's not like the government lending from one hand to the other, giving money from one hand to the other.
Just a quick comment. If we do have slightly unstable banks because of these kind of issues, we also need to remember that Thailand and South Korea, they attracted lots of foreign capital. The first round of foreign investment into Thailand and South Korea during the 97 crisis was investment into banks. So don't forget that this is a golden opportunity to diversify your shareholding. That's one comment. So every negative has a positive. The second comment is, I think, linked to what Prabodha said. Why don't we go after the ISBs and knock them down to the real bare bones? I think both of us come from equity backgrounds. We ultimately need foreign investors to come to Sri Lanka. So we need the foreign investor understands we are in trouble, but they also want fairness. We have enough bankers here. This is like, we shouldn't be taking, this is like the typical businessman who comes to the FCC in a Mercedes Benz and says, I want you to write off the debt because you don't have any security, right? I know how DFCC would treat a customer like that. You would never lend to them again. So we need to go back to the debt market. So we need to be fair. That's the most important thing I think all of us need to understand. We need to be fair, because if they feel we are not fair, forget about investing in debt. They won't even come back into our equity markets again. Thank you very much.
So I'll let Udara take it, part of it, but I agree with you, Niroshan. So, of course, when they've lost 70%, your bargaining power is greater. That's all. It doesn't mean that you should be nasty about it, and actually how you negotiate more than what you end up negotiating is so very important in this environment. So treating people with a lot of respect, a lot of transparency, showing a lot of genuineness in what you do, being able to do your own part. And that's another way in which domestic debt reprofiling can help. Say, look guys, you can take 50 and I can do nothing, and we'll all be in trouble again, and you have an interest. I mean, the question that these private bondholders, for ISB holders internationally ask is not how much are we getting. I think, are you sure you're really going to even pay that in 4 years' time? You'll know that they're really concerned about the sustainability of the solution. So if you say, look, I'll do a reprofile as well. This is what I will do. And can you do a little more? Because this works for us. I mean, you have to be quite open and honest about why you're doing it. And this is not to screw somebody over, but to get a better deal long-term for everyone. It has to be a win-win solution all around, right? Even for banks. So I think that's the spirit of this recommendation, that it is also offering then ISB holders a reason to accept a slightly larger haircut, because you're not simply trying to protect everything on your side and ask them to give everything, right? There is something in return on the table. I'll pass it on to Daria.
Udara, you want to respond?
No, I think Nishan's absolutely right that the sense of fairness is very important here. And essentially, what we should be careful of is there are two types of bondholders out there right now. One is the vulture funds who have probably bought the bonds at very low prices, very close to the debt suspension event. There's other class of investors that invested much earlier and have a genuine interest in being exposed to emerging markets debt. Think of the big funds in the West. So if we don't act fairly to them, who is actually going to buy Sri Lanka's debt in the future? So, of course, we can always just not pay anything. There's actually zero consequence. There's zero consequence not even repaying, sovereigns. Now, of course, the sovereigns may say they put trade embargoes, but all of this is very difficult to impose. So essentially, Sri Lanka has zero obligation to pay anything, other than the fact that accessing the markets as soon as possible is in our interests. And I want to emphasize that our objective shouldn't be to survive the crisis. It should be to grow out of the crisis. And just surviving the crisis is really a path to nowhere, where it's going to be more political instability and more of the cream of the crop, the youth migrating out of the country. And we need to get back on track to prevent this.
Thank you. I think I know there are a lot of more questions, but we need to wrap it up. But I'll thank you very much for sort of making it very long. But Nisha, in terms of, you mentioned any delay will be very costly. In your opinion, what would trigger government to sort of at least start talking to you about it?
I don't think there's a problem in for me to talk to government. I think the central bank, the Ministry of Finance are quite receptive, but it is, yeah.
Other way around, because it's the president who first announced domestic debt restructuring. Few days later, central bank governor ruled it out. So you understand from where I'm coming.
I mean, I think everybody is doing this for the first time in Sri Lanka, right? So understandably, there's a lot of uncertainty, kind of knee-jerk responses, and there's a lot of learning to be done. I would say we didn't start knowing all the answers, and we still don't. You have to learn quite a bit. I mean, I feel like I'd like to go through another debt restructuring. I know so much more about it now and could deal with it better in personal terms, even, right? So I think you see all the signs of that. But what is missing in government, I would say, quite apart from the adequate political kind of, I think, focus and leadership, is just the resourcing of the process. Now, you can't ask the governor of the central bank to do all the things that are needed to run the central bank and do debt restructuring. That's a full-time job. And the treasury secretary. So I always say, if I were doing this, I would put 150, 500 people even on the job, because it's not just the debt restructuring I have to solve. I have to solve the poverty problem. I have to solve the food problem. I have so many problems in the economy to solve. I'm ready tomorrow to hire 100 economists, and I'll have enough work for them. And in fact, I am talking to friends saying, can you finance 100 economists? Because this is what we need. If we are going to get out in a credible, sensible way, we need a huge amount of resources in just analysis. I'm tired of Sri Lanka making decisions without analysis, on gut instincts, on things that sit in top of people's heads, on untested hypotheses. We've got to put it to test. And we'll still make mistakes, things will still happen that's unexpected, but we'll reduce the probability of going wrong very significantly, and give ourselves the best chance to survive. And you can't do that with the current resources in the Ministry of Finance or even the central bank, right? We'd have to hire, why is it that we are working with Udara Piris of, because he's globally one of the best in understanding these issues and has enough networks and contacts and colleagues who have worked on these issues, and we think we have to bring his expertise into Sri Lanka. And there are dozens of people like that who then need to be supported by armies of analysts and econometrists and all that. So you've got to release the data, which is really hard. I mean, I could do more if the government just willing to give data. And then we need to really professionalize the process of analysis and decision making. And I think we don't have a culture for that, Nista. That's really part of the problem. The culture is not only missing in government. I apologize, it's missing in the private sector. I mean, ask about how decisions are made in your firms, and is there a paper produced to justify even your investment committees, bold moves, right? We don't do enough. I sit on investment committees. I am sad that we don't have the ability to do the kind of analysis that my friends do in much, as routine if they're sitting in some other country. That, any trader, my friends who are traders and often have 10 applied math PhDs working for them. They're not trading on their guts, right? And of course, they are the senior traders, but that's what they think it takes to understand how they should, make decisions on investment. So Sri Lanka I think, has a culture of not recognizing the value of analysis. And assuming that somehow we have insight because, so-and-so is my friend, or so-and-so told me so. So I think that culture needs changing. It needs changing in government, but it needs changing. If it changes even in the private sector, I think government can be significantly influenced by that. And I'll give you one thing to start off with, if you are willing to do it. When the budget comes up in 2 weeks, and there'll be maybe hundreds or sometimes 100 proposals, please ask, can we see at least a 3-page analysis on any one of these proposals that justify it, that say why it makes sense? Now, I know that's absent, and yet we make these hugely consequential budget proposals, but we can't produce a small document even for others to see why this is a good proposal for the country. Now, if we routinely come and praise budgets as private sector heads and gurus and say what a great budget it is, when there's no analysis to support the budget, then we are potentially part of the problem, right? But I think our gossip and how we respond to what government does shape government. Democracy is government by conversation, and the conversation we have really changes what happens. And I think we have to change the conversation in how government needs to function also. Thank you.
I'll end this with a comment, because a former governor did defend or justify the homegrown solutions, citing lots of economists within that institution, the central bank. So no responses, but thank you very much for the experts, as well as especially Udara, for joining us online, and for insight, Nishan particularly. I know there's a formal vote of thanks from Acuity Partners. So, and thank you very much from the participants as well for making it very interactive.
For more latest news, subscribe to FTTV.